Good afternoon, everyone. Thanks for your patience as we work through some technical issues of getting back to the application of technology to do our 12th annual Investment Manager webinar today. We're thrilled to have you with us today and want to thank you all for joining us. Our relationships with you, our partners in the asset management community, are very important to us. And our goal with this webinar today is to provide an update on NEPC, an update on our investment research team, and how we underwrite managers. So we'll start with an NEPC update and market outlook, and then I'll describe NEPC's research coverage and process. We'll talk about manager search activity and trends that we've seen in the last year. And we'll go into a couple of key initiatives, like an update on our outsourced CIO business and our approach to fee negotiations. So I'm joined today by Sheth, who's a senior member of our team. He's a partner at NEPC, and he's going to talk about our fee negotiations with managers. And also joined by two members of our outsourced CIO team, Klapinsky, who's a partner and head of portfolio strategy, and Raman, who's an investment director on our OCIO platform. And I'm Sarah Samuels. I'm a partner at NEPC and the head of investment manager research. So first, we'll give you a little update on NEPC and our business. So we remain independently owned by our 45 partners, and our independence allows us to put our clients' interests first. It allows us to avoid conflicts of interest. 100% of our revenue comes from advisory and discretionary investment services. And our ownership structure allows us to be nimble in our approach to a rapidly changing investment landscape. We have over 300 employees, and we operate out of 7 regional offices across the country. We have a good amount of people working from other locations across the country remotely as well. And we work across 7 client types. So that includes private wealth, endowments and foundations, public pensions, corporate defined benefit and defined contribution, Taft-Hartley, and insurance. And our client-facing consulting teams are organized according to these client types, while our research team is organized by beta, or market exposures. We have over $1.5 trillion in assets under advisement as of January 1st of this year, and we have roughly 400 clients. So our goal at NEPC is to be big, but to feel small. And what we mean by that is that, we bring our vast resources to bear to our partners, and that includes our managers and our clients. But we offer each client customized service, and we have an extremely low client to consultant ratio. So each year, Greenwich Associates conducts a survey of institutional investors. And I just thought it would be helpful to highlight some key themes that institutional investors are reporting and thinking about, because these are your potential clients or your current clients. And then we'll get into NEPC's team and investment approach. So this page shows a number of considerations that institutional investors address at any given time. This page shows that asset allocation, market volatility, rate of return and funding issues, and risk management were among top concerns and challenges for all client types out there. And this makes sense. It's not as easy for institutions to achieve their program's required rate of return, given the market environment we've had for the past 10 or 15 years. On a go-forward basis. And it's unclear how clients should shape their portfolios in response to the uncertainty that we're seeing today in the market, with rising rates and geopolitical risk and inflation. So speaking of inflation, last year during this call, I noted that inflation would likely be of higher concern in the next survey. It was not on people's minds last year. And sure enough, if you look to the middle to right-hand part of this page, the number of clients worried about inflation has increased about 4-fold, probably increasing every day. So it's going to be difficult for our clients to achieve CPI plus 5%, for example, for endowments, or a 6.5%, 7% plus nominal rate of return for a public pension fund. And we could go on and on, at least not with beta exposures alone. And so the solution for many clients is twofold. One is to pick excellent active managers, and that's where we and you come in to that part of the solution. And the other is to shift into riskier and less liquid investments. And we're seeing a big shift into private markets, which I'll talk about in a moment. This slide shows the same survey respondents sharing their expected asset allocation shifts over the next 3 years. There are a couple themes worth highlighting. One is that active U.S. equities are more likely to have low allocations in the next 3 years as more investors plan to allocate to passive implementation than active in U.S. large caps. And this makes sense. It's a more efficient area of the market. It's historically proven difficult to generate alpha net of fees, especially. And the second theme on this page is that we've seen investors reevaluate the role of hedge funds in their portfolios. And this capital generally is being reallocated to private markets in search of that higher total return. Another theme that is important to highlight is that ESG has become increasingly important for institutional investors and allocators across the globe. We've got Europe leading the charge, which they've done for some years, very much ahead of the curve, and then Asia, and then the US. So ESG is very quickly becoming table stakes. And if you, as investment managers, general partners, are not thinking about how this fits into your investment process, it would probably be prudent to begin to do so now. Clients are really paying attention to this. At NEPC, ESG is part of our DNA. It's not an add-on service that we offer to clients. And we look at really 4 ways of implementing ESG for our clients. One would be negative screening. The next, and probably most common, is ESG integration within the asset manager's strategy. Then we have thematic investing and corporate active engagement. And so we have at NEPC a 20-member committee spearheading this effort, and we rate all of our strategies with our proprietary ESG framework. DEI is also a priority for us, and I'll talk about that a little more in a moment. So these are some themes from the broad industry, the high-level view of themes to be aware of. If we drill down to NEPC's clients and where they've spent their time, we did 595 searches in 2021. These were searches or reviews of asset classes. And this represented $26 billion of assets invested. This number is more or less in line with what we've seen over the last couple of years, but these numbers can move around quite a bit from year to year due to large clients who might be swinging the numbers, or meaningful turnover with large managers that have a big or significant event that's causing clients to move. So some themes have been in place for the last 3 years, like high search activity in international equities, global equities, emerging market equities, and this makes sense. We have higher alpha expectations in these areas, and we've seen higher alpha being delivered in these parts of the capital markets. On the domestic side, we continue to see that downward trend in U.S. large cap activity. And if we tie that back to the Greenwich data that I just outlined, this shows institutional investors' expected asset allocation changes being reflected real time with what our clients are doing. Fixed income search activity hasn't changed all that much, but it has declined slightly. And in private equity, we continue to see high search activity, but unlike the public markets, search activity is a function of some other things as well, including clients ramping up their private equity exposure in search of capturing that return premium over public markets. And it also reflects that recurring cadence of fundraising that we see in private markets. This next page, so this is a snapshot of 2021. The next page shows this historically, year over year. So I'm going to shift gears now and tell you a little bit about the status of our team and who's covering what and what we're working on. So these next few pages show our research team org chart, and it's cut a few different ways. Here we show our leadership team within research. We have our asset allocation and portfolio construction teams. We have global research, research operations, ODD, portfolio strategy. On the right-hand part of this page, this is our investment manager research team. And as you might know, we're organized within manager research. This gives a little more data. But within manager research, a couple of years ago, we organized our team according to beta. And what I mean by that is if you look at the left-hand side of this chart, we have our marketable securities team, and this includes our long-only and hedge fund strategies. So Will Ford leads our equity team, for example, and this is composed of long-only and hedge fund equity long-short specialists. Dolari Pancholi oversees our credit and multi-asset teams, and with these teams, our long-only credit researchers sit next to our credit hedge fund investors. And really, we believe that that's just a good, sound investment approach, that it reflects us taking a CIO mindset, thinking about the entire liquidity spectrum, and being deliberate about how we recommend our clients put their capital to work as opposed to operating in silos. On the private market side, we have Josh Beers, who leads our private equity team. So that's our venture capital, growth equity, and buyouts. Oliver Fadley leads our private debt team, and Matt Ritter leads our real assets team. So that's real estate and hard assets. And this page is probably the one that you're most interested in. This shows our coverage. So if you're looking to speak with an investor here at NEPC, what we've done here is mapped out coverage by each investment professional by asset class. And this presentation will be made available after we're done. In terms of our process, our investment team has a disciplined approach to evaluating and underwriting and ultimately recommending investment strategies to clients. So our process begins with our research team screening both our proprietary internal databases and external databases for potential managers. We also tap into our extensive networks. Then our investors do a performance review to look at the strategy's excess return stream over time, to contrast each manager's true embedded beta and true skill, and see how that compares to returns in a universe. So here we're looking at traditional performance metrics like risk-adjusted return and drawdown. But we're also using more sophisticated metrics that we've built internally, like factor attribution, likelihood of success, and signal versus noise. So once we've isolated the managers that we're interested in doing further work on, our investors meet with the managers to assess the investment team. We look to understand the firm's business focus. We want to understand your investment philosophy. What is your investment edge and why is it sustainable? We want to understand the consistency of your style and verify return attribution. When we are ready to recommend a strategy to be rated on NEPC's platform, we bring this recommendation to NEPC's centralized due diligence committee or alternative asset committee. These are our internal committees that are made up of senior members of the firm. That includes partners and senior consultants, and we meet quite regularly. And we bring forward our investment thesis. We address any issues or questions that are being asked by the folks on these committees. And all successfully vetted managers are considered research qualified, and they're added to a focused placement list. We have a 1 through 5 rating system, with 1 being our highest conviction and 5 being something we wouldn't recommend for client portfolios. So our investment approach, this is just a little bit more detail into how we think about things. And I would just draw your attention to the left-hand side of this page and the right-hand side of this page, those 2 columns there. It combines a quantitative analysis and a set of tools that unpack signal from noise. And you'll likely hear from our researchers with questions about what we find through these quantitative tools. We also have a deep focus on qualitative factors. We want to understand if incentives are aligned. So are our clients making money when the managers are making money? We're going to be looking at business strategy. So we're watching for product proliferation. We're looking for viability. Can this strategy that you're running support your business? And can you continue to be a going concern if it's a low level of assets? On the flip side, if assets are being raised rapidly, does that threat the alpha potential? We're looking at succession planning. So how is that next generation of talent being groomed? And how are the economics of the firm being transitioned to that next generation if it's independently owned? And then this page is just a small subset of the components of our diligence process. So we spend a lot of time, many, many, many hours when we're underwriting a strategy, and we'll most definitely touch on each of these. Our rating scale is listed here. So on the right-hand side of this page, we define our 1 through 5 rating system so that you can understand how we view these. And I think an important point to note here is that our 2 and 3 rated strategies can be very appropriate for client portfolios, and they should not be viewed as a poor rating. So anything 1, 2, or 3 rated we view as appropriate for client portfolios, and 3 rated might be more appropriate for some clients than for others. The left-hand side shows just a very high-level summary of the areas that we dig into with our investment process. This is a high-level summary of our what we call our investment framework, which is essentially a model that we use to guide our diligence. So we have a number of key initiatives we're going to be focusing on in the coming years. One is fee negotiations. You're going to hear from Sheth about that in a moment. Our outsourced CIO, or discretionary business, continues to grow, and you're going to hear from Chris and Varun on that. We continue to invest in our private markets capabilities. We have clients that are ramping up their exposures, and private markets are more labor intensive. It requires getting out there, traveling a lot, meeting with GPs, meeting with fellow LPs, cultivating our network, managing our brand, and getting access to the best GPs that we can for our clients. As I mentioned, we're focused on DEI. And we have launched a new program called our Explorer platform. And this is just a way for our investment professionals to identify, engage with, and rate diverse-owned and diverse-led investment strategies that are not currently 1 or 2 rated. And we define diverse-owned as a firm that's at least 50% owned by an underrepresented group, and diverse-led as a firm that's 33 to 50% owned by an underrepresented group. So we're really excited about this focus. We've found some excellent strategies, and the intention here is really to just supplement our normal due diligence process, not to circumvent it. We are taking very proactive measures to improve the chances that diverse managers have of getting capital if they're skilled. And then on ESG and impact, we continue to look at managers' ESG integration, and we work with our clients increasingly so to align their organization's investment pools with the mission that they have for that investment pool. So it's a really exciting time. So with that, I'll turn it over to Varun.
Thanks, Sarah. It's good to have the investment community on the phone with us. Happy you're able to join today. We wanted to give a brief update on NEPC's OCIO, or Discretionary Services platform. I believe a lot of the investment community is familiar with our service offerings, but it's great to just check in and just give a brief update on various developments from our group. The slide that's up on the screen now just gives a nice snapshot of where we stand through the beginning of this year. We have about 200 investment portfolios on our platform, which amounts to, I would say, about 100 clients. And that equates to about $67 billion in assets on our OCIO platform. And another important number behind the AUM and the number of portfolios is we have about 30 people across the investment team, the trade support and operations group, and of course the legal team that provides the backbone and is able to work through these portfolios on behalf of our clients. Moving to the next slide, this gives a summary of why clients tend to use NEPC's outsourced CIO model. RFPs that we've seen as of late, we've seen about half of prospects seeking some sort of OCIO servicing. So we've been able to qualitatively figure out what types of responsibilities and offerings prospects are looking for. And these can be distilled into 3 different categories. First and foremost would be simplification. We do the heavy lifting on behalf of our client base. We work with the investment managers that are on the phone today. On top of that, we also handle the trade support and investments that we put in. And of course, we liaise with our legal and operations team as we work through new investments or if we see any revised guidelines. This also leads into the agility that we're able to provide our client base. And this is in regards to trades that we can put on or put off, and this has been extremely important the past couple of months, given the pronounced volatility that we've seen across global markets. So we've been able to share this benefit with our clients when we're able to tap into and tap out of markets should we see opportunities of dislocations. And then lastly, also as important is scale. Thinking back to the previous slide, we have about 200 portfolios on our discretionary platform, and that has allowed us to achieve optimized processes or scale, which has led to efficient doc reviews, trade support, how we submit trades, and of course, this has also led to fee savings with the big chunk of investment managers that we work with, which Sheth will discuss in the next section. The last piece I wanted to touch upon before I hand it over to Neil is that, as members of the community may have found out, we recently released something that we call the NEPC Access Vehicles. This is a manager of managers approach that's been years in the making and is a tantamount to the collaborative effort across not only the folks at NEPC, but with the investment community. We have created two different types of access vehicles, one focusing within global equities, the other focusing within EM equities. These are areas teeming with alpha opportunities. And we're able to leverage our resources internally, leaning on our value add that we touched upon in the previous slide regarding scale, portfolio rebalancing and agility, and of course, the simplification in regards to reporting, getting daily NAVs, and then working with our client base as we continue to grow this service offering. Speaking of which, given the success of our access vehicles that we launched about 6 months ago, we're now looking for the next phase of our product offerings, and we hope to journey into this next step sometime in 2023 or possibly 2024. And now I'll pass it on to Neil.
Thanks, Varun. Appreciate it. And thank you to the managers, many of which I've personally dealt with over the last number of years regarding fees. So if we can, thanks, Sarah. So as many of you know, our research team has negotiated fee discounts for our clients for as long as I have been here and more, so well over 15 years. Over the past year, we built a proprietary data analysis tool, which helps mine our databases and calculate these fee savings, management fee savings for clients. And we're about to actually roll out a second generation of this tool in the upcoming week. And so today we have nearly 500 investment vehicles where we have fee savings for our clients. And that is represented by long-only funds, hedge funds, private markets vehicles, as well as a lot of SMAs. So next, we really, how we deal with fees and we approach fees in our conversations with you all is really across a few main principles. One is that in our view, over the medium to long term, fees should not represent more than 20 to 25% of a vehicle's outperformance over a passive benchmark. So I'll say that again. It should not represent more than 20 to 25% of the outperformance over a benchmark. So that is a key message. And we are very clear and straightforward with our clients and with our managers in terms of our search books and how we show this. So our long-only search books show the performance and fees for all managers being considered, along with the investment universe median fees. And we also show the negotiated fees for NEPC clients next to these standard fees where they're applicable. So it's right out, and we do show this to our clients. So I can tell you where we're spending time right now with you all. And so we're targeting high exposure investment manager funds where either NEPC clients do not have a discount to standard fees, or frankly, the performance over the medium to long term, we feel does not justify the fees charged, meaning the fees represent over 25% of the alpha over a benchmark. And so I know a number of you on the phone today, we've worked together successfully over the past few years, and we thank you for that. And as a number of you also know, that this process can sometimes take longer than either one of us would like, and that, I think, comes from not only understanding how we're going through this process, but not only that your investment team understands that we monitor and manage money for all of our clients and know all the competitive products and fees. And so what we're trying to do is show you and arm you with that information as you talk to your own teams. So thank you very much for working with us. Back to you, Sarah.
Excellent. Thank you, Neil, and thank you, Varun. So just in summary, before we open it up to questions, and we would love to hear from you, we hope you enjoyed our update on NEPC today and that you found it helpful. In terms of how to work best with NEPC, you can stay on top of our reviews at nepc.com. Please bring your best ideas forward, so quality is always better than quantity. As Neil mentioned, we would love it if you'd be prepared to offer competitive pricing, and we can definitely get creative in ways that make everybody feel good. And being willing to take no for an answer can be really useful in developing our relationships. And we'll do our best to be clear with you as to why a strategy of yours may not be appropriate, but we hope that it is, or that we may not be able to do further diligence on. We really value our partnership with all of you on the call today, and we look forward to many years of collaboration ahead. So with that, we'd love to hear from you. I think the chat box is open, and we have some questions coming through. So the first one is a question about our definition of a diverse strategy. And the question is, I thought that diverse-led would be a strategy or product led by an underrepresented group. Do you think about that at all, or is it just ownership of the firm? And the answer is we absolutely think about the team touching the money and managing the pool of assets. It is part of our DEI ratings grid and tool that we use, which is relatively new, part of our investment framework. And we are not only looking at whether a firm is owned by underrepresented groups, but also who's touching the money. Okay, so here's a question for our OCIO team. When you add more NEPC access vehicles, what areas will you look to add? Domestic equities, EM debt, et cetera.
That's a great question. We're doing a lot of legwork now. We see opportunities for an access vehicle, possibly in the long duration assets area within fixed income. And we're also looking into some alternatives, most likely within the private market space, but more to come in those areas.
Excellent. So that's all we have for questions. We'll give another couple of seconds. Here we go. Does NEPC disclose ESG ratings for firm and/or strategies? And the answer is yes. If you have, a relationship with a researcher, and I'm sure that you do, they'd be happy to walk you through the rating system that we have for ESG and provide feedback on areas where you might be able to improve relative to your peers or areas where you're excelling. We have a question here. What positions are you looking to add on the research team? And so we have, I believe, about a half a dozen open positions. We are looking for a senior professional on our real assets team. We are looking for somebody who has experience covering hedge funds or multi-asset strategies. We're looking for a credit researcher, probably on the analyst level, not the very, very senior end. And we're looking for sort of an entry-level person. I believe we also have an ODD opening as well. Thank you for asking. We'd love to hear from you with candidate recommendations. Excellent. Well, thank you very much, everyone. We're so pleased to spend the afternoon with you, and a recording of this presentation will be made available on our website.